In our last lecture, we were discussing an investment center. An investment center is a part of the business that management is evaluated based on what kind of profit or return they can bring in on the assets they have access to in the organization. Those assets were investments that the owners made, and so they call that the return on investment, or the profit that was made on the investment the owners put into the business. We looked at an example where we looked at the return on investment and we looked at the sales margin and the capital turnover. So the return on investment is how good of a job, how much profit the managers are making with the assets. The sales margin helps us to determine if the managers are getting a high return on investment because they have clear differentiation, meaning they have low substitutions of their product. If there's a low substitution of their product, they can get a higher profit margin, we're saying a sales margin, on that product. They can charge more. If the business is instead maybe doesn't have differentiation, they can also have a strategy based on being a low-cost leader. In order to be a low-cost leader, you have to be an efficient management team. If you look at the return on investment, you can break it down based on the sales margin or the capital turnover to help you understand what is driving that return on investment. Another tool we can use is called residual income. And residual income just says how much profit or operating income are we making beyond the minimum amount. When an investment team puts money into a business, they want a minimum return that they have in mind. You're not going to invest money unless you have some kind of an idea about what kind of profit return you want to make. And so if you make more than that, then that's called residual income. How much more are you making than the minimum? Now, the residual income then is just taking the operating profit, the operating income, which is our profit, minus the target rate of return times the assets that were invested in. So our business, we wanted a minimum of 25% return. This is information that would be given to us. The operating income is $2,785 for the beverage division. And so the minimum return that they would accept is 25% of the $28,128. That would be $7,032. They're not making the minimum, so that's why they have a negative residual income. They don't have residual income. They're making less than the minimum. Now the snack division has a minimum required return of 25%. 25% of 5,375 is 1,344. Basically, they're making $2,960 more than their minimum required return. So they're making a lot more residual income. The reason this is a useful tool for evaluation is because oftentimes, if you look at the snack division, they're making an 80% return on investment. So the snack managers are going to probably reject any new business plan that's lower than 80%. But if a project comes in at, say, 50%, that might be a great project, but they're already making 80, so they're going to reject it. But that could be detrimental to the business as a whole. So by using residual income, it says anything above 25%, the managers are going to want to accept. And so this is more of a situation where residual income can really benefit the snack management team because it allows them to take on projects that are above 25%, but allows them to take on projects that are below the return on investment that they are already making and still be useful for them as managers. That wouldn't hurt them as a manager to accept that. Next, we're going to look at a tool that management has called the flexible budget format. Now, it's important to understand a flexible budget does not mean a budget has wiggle room. It does not mean that at all. What a flexible budget means is that we're going to make our budget comparable to our actual level of volume. Remember, variable costs are going to change the more activity, the more you manufacture, the more you sell. So the more the volume is, the more those variable costs will be. Let's look at what we mean by that. First of all, start out with your basic contribution margin income statement, where we take the sales revenue minus the variable cost minus the fixed cost. We have the per unit amounts. that include how much we're going to sell the product for minus the different variable costs. So each unit costs us for the cost of goods sold, for the commission, for the shipping, etc. The actual cost and master budget information is provided for you. So each unit costs $20, so your master budget is going to be derived by taking 30,000 units times 20 equals $600,000. And then you do the same thing for each cost. 30,000 units times $12 equals $360,000. The actual amount is determined by what was actually collected and which was actually spent. So that information is not based on multiplying the sales volume times the per unit amounts. That information is based on from what happened when the business was actually in operations. When we compare these two, we get a master budget variance. Notice the sales volume did very well. We sold 2,370 more units than we expected to. Our master budget expected 30,000 in sales, we sold more. That's a favorable variance. So when sales are higher than the budget, that's favorable. But when the costs are higher than the budget, it's unfavorable. Notice how every single one of those variable costs are unfavorable. This might seem like a bad thing for managers, but it really doesn't mean that, not yet at least. Remember, each variable cost is going to increase with the more products you sell. So since the master budget is only based on selling 30,000 units, but we actually sold 32,370 units, then of course our variable costs are going to be higher. What we need to do is change the master budget to be the same level of activity of sales as the actual sales volume. So when we change the flexible budget to be the same level as the actual sales from 30,000 master budget to 32,370, our budget for our variable costs are going to change, but our budget for our fixed cost will not. Fixed costs are going to be the same whether it's the master budget at 30,000 units or at 32,370, but the variable costs will change. So now you take 32,370 times $20 and you get what the sales would be if the volume of sales were 32,370. The difference between the flexible budget and the master budget is called a volume variance, because the only difference between the numbers in the master budget column and the flexible budget column, the only reason you have that difference is because of the change in volume. So the volume variance only occurs because of the change from 30,000 units to 32,370. This variance is okay. It's not a bad variance. So all those unfavorable for variable cost are not really a problem, because they're unfavorable because a good thing happened, because the sales volume went up. So a volume variance is an understood variance. A volume variance is an expected variance. A volume variance is not something that would show poorly to a management team. However, the difference between the actual and the flexible budget, now that could be a problem. Any difference between actual results and the flexible budget column will help us to understand management's capabilities. They call this column the flexible budget variance. So this flexible budget variance is based on management doing a good job or a poor job. It's not based on changes in volume. So looking at the flexible budget variance, we see differences that are based on management's performance. None of these differences in this column have anything to do with the volume change. The variable costs were increased to match the same level as the actual sales volume. So the cost of goods sold being favorable means that the management was favorable or efficient in deriving the cost of goods sold. Commissions being unfavorable means that the commissions were higher than $2. They must have paid more. That's the only way it would be unfavorable. The shipping being favorable by $2,560, well, that just means that the shipping must have been less than $2. So management was very efficient with their shipping. Bad debt, I corrected it. It was supposed to be 1%. Notice the fixed costs. Looking at fixed costs, we get the actual amounts versus the budget amounts. Now, the flexible budget is going to be the same as the master budget because there are no volume variances for fixed costs. Are going to be the same at whatever level. But the reality can be different from what was budgeted. In other words, the salaries, there might have been a raise that was not accounted for. Advertising, there might have been an increase from the advertising company that they didn't account for. And because they didn't account for it, we got an actual variance. But that variance had nothing to do with the volume because it was a fixed cost. Using the flexible budget format, we can get a better understanding of what management should be held accountable for, what they have responsibility for, which is the efficiencies that they build into the system and the job they do. It takes out any factors based on the variable costs changing based on the volume changes.